notes, you say you remain irrationally bullish for 2019. What does that mean?
Irrationally, because if you think about all the threats we faced this year, the U.S.-China trade war, global earnings decelerating, Brexit, the laundry list of risk scenarios and potential problems, you would never know that global equities are on pace to annualize almost 30% returns this year. Commodities are up almost 17% on an annualized basis. It's actually been a really great year for risky assets, but you'd never know that for conversations that we have. You hear from a lot of different investors. Now, the reason we're bullish through the end of the year, there's really two reasons, actually. The first is investors are positioned incredibly bearishly. They've got defensive allocations within equities. They've got large allocations to bonds. And whenever investor positioning is quite this cautious, it's historically been a great time to own risky assets. Our bull and bear indicator of market sentiment on a 0 to 10 scale, it's below 1. So it's about as bearish as you can get. And again, in the past, that's been a great sign for short-term upside.
Jared, is that view also contingent on none of those headline risks that you outlined at the top of your first answer getting worse?
Well, obviously anything can change, and if trade, for example, takes a really bad direction, or if something goes wrong in negotiations around Brexit, there's always potential for risk. But a lot of these that we think are very familiar to investors at this point, arguably even priced in. And this is in a moment where kind of the second catalyst for more upside, you still have very easy and accommodative monetary policy. Bank of America Merrill Lynch expects the Fed to cut more this year. And if you look at housing data, look at the mortgage refinancing boom, it looks like there's still some gas left in the tank with regard to the power of interest rate cuts by the Fed.
Mark, there just seems to be so much dysfunction kind of emanating out of D.C. right now. We can talk about impeachment inquiry in the House, or just gridlock on quite a number of policies in Congress overall. In general, we could talk about trade and all the uncertainty there. How big of a risk to the markets are D.C. politics right now?
In the short run, it is a huge risk. It's going to drive a lot of volatility in the short run because that's what political headlines and noise do. They drive a ton of volatility. In the long run, though, what drives investment performance is not politics, but policy, right? So monetary policy, trade policy, what we're doing on those two fronts, and also profit. So, as I mentioned earlier, we're looking for the Fed to cut one more time. We really want to see a trade deal, right? I don't know if that's going to happen. I don't know how much incentive China has to get a deal done right now. And again, we need to make sure we see earnings moving in the right direction.
Would Congress actually passing USMCA, would that help offset some of the angst around China and a trade deal there?
I don't think it would be impactful enough. The big issue right now is that China trade deal, right? And that's what's causing so many CEOs to think about moving supply chains and trying to figure out how to handle, this problem and that problem so that they can try and plan for the future. So I think the bigger issue right now is definitely China.